Opendoor just had one of its roughest trading sessions in weeks, closing Monday down by a painful 12.4%, falling $1.19 to finish the day at $8.38 per share. That's a big drop in a single session, especially for a stock that has been riding a wave of momentum and optimism over the past few months. And while some investors may look at a move like this and feel rattled, others will see it as part of the natural ebb and flow of a volatile story stock that is still finding its footing. In this video, I want to break down what I think drove today's pullback, why the momentum broke, and what investors should focus on heading into the next stretch of trading. The first thing to say is that a 12% drop does not happen in a vacuum. Something triggered this reversal. On the surface, nothing about the fundamentals of Opendoor changed overnight. Kaz Nejatian is still CEO, Keith Rabois is still talking about efficiency and cost discipline, and Eric Wu is still on the board buying shares and signaling confidence. But market sentiment is a fragile thing, and when the tone shifts even slightly, it can create outsized moves in both directions. In this case, I think one of the sparks came from the retail side of the story. If you followed Opendoor's rise this year, you'll know that a lot of the energy has been driven by retail traders, the so-called Open Army. And at the center of that energy has been Eric Jackson. Jackson has been tireless in promoting the Opendoor story, calling it the next great turnaround, and even standing outside Drake's house to symbolize his conviction. His relentless advocacy has galvanized a community of retail investors who are not just buying shares, but actively spreading the narrative online. That kind of momentum is powerful, but it's also delicate. When the figurehead of a movement shifts attention, even slightly, it can create ripples. And that's exactly what happened today. Eric Jackson began talking up another stock, a company called BETR. On its own, that shouldn't matter too much. But to the retail community hanging on every word, it felt like a distraction. It raised questions about whether the energy and attention that has been laser-focused on Opendoor might start to spread to other plays. That matters because retail investors thrive on conviction. The higher the collective resolve, the harder it is for shorts to pressure the stock down, and the more likely momentum feeds on itself. When that conviction wavers, even a little, you can see it reflected in the tape. Some traders may have sold their Opendoor shares to chase BETR. Others may have simply felt less confident holding through volatility. Whatever the reason, the effect was real. Momentum cracked, and in a stock that has been priced partly on narrative and partly on execution, the narrative side took a hit today. Now, let's not overstate this. Retail chatter alone doesn't cause a 12% move without other forces amplifying it. That's where the institutional side comes in. Remember, Opendoor still has very high short interest. Some of the biggest names on Wall Street are positioned against it: Jane Street, Squarepoint, Group 1, Walleye, Simplex, and Martin Shkreli, who publicly disclosed his short entry around $9.36. When momentum is in Opendoor's favor, shorts feel pain. But when momentum cracks, they seize the opportunity to push. A wobble in retail conviction gives shorts an opening to press their positions harder, leaning on the stock, adding downward pressure, and hoping to shake out weak hands. That's exactly what I think happened today. Retail got spooked, shorts pounced, and the result was a sharp, painful pullback. From a business perspective, there was also fresh news that may have unsettled some investors. Kaz announced that effective September 29th, Opendoor will become an in-office company. Remote work is ending. That's part of the cultural reset Keith Rabois has been calling for, but it also raises questions. Does this mean morale will take a hit? Will talent walk out the door? Is it the prelude to layoffs? Investors know that cost cuts could be a catalyst, but the uncertainty around how aggressive those cuts might be and what impact they might have on operations creates another layer of anxiety. In the absence of clear details, the market often assumes the worst. That probably added to today's selling pressure. So when you put it all together, you have a convergence of factors. Retail conviction gets diluted by Eric Jackson spotlighting another stock. Shorts sense weakness and push harder. Leadership makes a cultural announcement that hints at deeper changes, possibly job cuts. And all of that comes against the backdrop of a stock that has already run up significantly in recent months, leaving it more vulnerable to profit-taking. It's the perfect storm for a sharp pullback. Now, here's the key question: what do we do with this? Is today's move the start of a deeper decline, or is it just a bump in the road for a stock that is still in the middle of a major reset? Personally, I took today as an opportunity to add a little more to my position at 860. Why? Because the fundamental story hasn't changed. Kaz is still moving at speed. The national rollout has been accelerated. Pricing models are being revamped. External PR firms have been cut in favor of direct communication. Insider buying is happening. Those are the things that matter. A single day's shift in retail attention doesn't erase the larger reset that is underway. That doesn't mean there won't be more volatility. Stocks like Opendoor rarely move in straight lines. There will be up days, down days, and everything in between. But the long-term trajectory depends on execution. If Kaz continues to deliver on his promises, if the company shows tangible progress in pricing accuracy, operational efficiency, and product innovation, then the narrative will strengthen again, and retail conviction will return. In fact, these dips often serve to shake out weak hands and consolidate the shareholder base around people who are truly committed to the story. There's also the short interest dynamic to keep in mind. The higher the short interest, the more combustible the setup. Days like today relieve some of that pressure, but they don't resolve it entirely. If the stock stabilizes, if the company drops another positive announcement, or if insider buying continues, shorts could once again find themselves squeezed. The risk for them is that every incremental improvement in the business makes their position less tenable. That's why they seize on moments like today to push as hard as they can. They know that the window may not stay open forever. It's also worth noting that leadership changes like moving to an in-office model are not inherently bearish. They're disruptive in the short term, but they can strengthen a company's culture in the long run. Keith Rabois has been outspoken about Opendoor being bloated and inefficient, even suggesting that only 200 of its 1,400 employees are truly necessary. If that's true, then streamlining the workforce, enforcing accountability, and rebuilding a culture of speed could dramatically improve efficiency. Investors may be nervous about the transition, but if it results in lower costs and higher margins, the long-term impact would be positive. So what's the takeaway from today's painful close? To me, it's that momentum is fragile, but fundamentals are sticky. Retail conviction may have wavered when attention shifted to another stock, but the bigger story of Opendoor as a company in reset mode is still intact. Shorts may have pressed their advantage today, but they remain at risk if the company continues to execute. And leadership may be making disruptive changes, but those changes are aimed at building a leaner, faster, more effective organization. For shareholders, the challenge is to separate noise from signal. The noise is a day's worth of trading, the chatter of retail shifting focus, the speculative fear around cultural changes. The signal is Kaz's execution, insider buying, the acceleration of the national rollout, the revamp of pricing models, and the determination to turn Opendoor into a true software-driven platform. If you focus on the signal, then today's pullback looks less like the end of a rally and more like another test of conviction. Of course, that doesn't mean the road will be smooth from here. There will be more volatility, more distractions, and more attempts by shorts to exploit moments of weakness. But that's the nature of investing in turnaround stories. They're messy, they're unpredictable, and they reward patience. If you believe in the mission and the leadership, then days like today are opportunities rather than reasons to panic. In the coming days, I'll be watching closely for a few things. First, whether retail conviction stabilizes or continues to drift. If Eric Jackson refocuses his energy on Opendoor, the community could rally quickly. Second, whether there are any concrete announcements around workforce cuts or cultural changes. The more clarity investors have, the less room there is for fear. And third, whether insider buying continues. Nothing signals confidence like executives putting their own money on the line. In summary, today was painful, no doubt about it. A 12% drop hurts. But it doesn't change the long-term reset that is happening inside Opendoor. The company is still transforming at speed. Leadership is still focused on efficiency, pricing, and innovation. Shorts are still heavily exposed. And the retail community, while temporarily distracted, still has deep conviction in the story. This is the nature of volatile stocks. Momentum can break in an instant, but conviction, execution, and vision are what ultimately determine where a company goes. That's why, despite the red close, my optimism remains intact. I added at 860, and I'm holding for the bigger picture. Because in my view, the story of Opendoor is far from over. In fact, it's only just beginning.